Friends, welcome to our finance and investing tidbits on our FIN-TRAINICA channel. The purpose of this video is to discuss the concept of margin of safety and why it is important for equity investors. Welcome to the video. Concept of break-even point is that level of sales where the company does not make either any profit or loss. This is not the level of sales that any company would like or aspire to be, but at least calculation of this tells us about the level below which we just can't afford to go in terms of sales. Break-even point can be calculated as fixed costs of the organization for a year divided by the contribution margin of the basket of products that the company offers. So here we're not talking about one product, but the entire range of products and their collective contribution. If we divide that by sales, collective sales, we get the collective contribution margin percentage. Now, if we divide fixed costs by this collective contribution margin percentage, we get the break-even point. This contribution margin percentage, as I've just mentioned, can be derived as sales minus variable costs for all the products together. So we have to derive the contribution for all products together and divide that by sales, and that will give us the overall contribution margin percentage for the organization. Of course, I have discussed the concept of variable cost in a separate video, so you can explore that if you're not very clear about the concept of variable costs. Margin of safety is the difference between sales, which we are currently already at, and the break-even point, which are the minimum sales that we need to achieve so that we don't get into a loss situation. Now, the difference between the current level of sales and the break-even level of sales gives us the margin of safety. And this, of course, is on the assumption that the sales are more than break-even point. If sales are less than the break-even point, the actual sales are less than the break-even point, like what happens in the early stage of a business, then of course we do not have any margin of safety at all. In fact, we have a negative margin of safety, which is worse. But what we are talking about is in a general state of business where the company has been long well established and the company is doing well. At that time, the current level of sales would be far higher than the break even, and the gap between these two can be called as the margin of safety. For example, sales of a company are 500 crores and the break even point is 280 crores. Thus, the margin of safety would be the difference between 500 and 280, which is 220 crores. It can also be expressed as a percentage of sales. For example, in this case, 220, which is the margin of safety, divided by 500, which is the current level of sales, gives us percentage of 44%. The rule of thumb I use, I have not found this being specifically discussed in any book. It may be mentioned in some book, I have no way to know, but at least the books that I have gone through, I have never found anybody talking about the benchmark. But the benchmark that I like to use is that the company should have at least 40% margin of safety. If you're looking at this company as an investor, then we have to be very careful about the margin of safety, because margin of safety tells us the cushion. Now, if you have a very narrow cushion, just say 10% margin of safety, then the company is very vulnerable. It can slip into losses very quickly. So naturally, more the margin, the better it is. And therefore, at least 40% margin is what I advocate. The margin of safety acts as a cushion, as I've already mentioned, and even in a situation of some economic downturn or natural calamity, the firm can survive the difficult phase relatively easily, whereas those firms which have a very less margin of safety will very quickly slip into losses. For retail investors, this aspect is very important, since retail investors can very quickly suffer from fear in the market, and that's where they have to be very careful. And companies with high margin of safety provide the investors that necessary cushion and cover. So we experienced this during the COVID-19 pandemic, that companies which had a poor margin of safety slipped into losses very quickly, whereas those companies which had a very strong margin of safety were able to survive. Of course, this is also a sectoral issue. For example, hotels which had a very strong margin of safety would have also suffered during the COVID-19 period when there was no business at all for these hotels. But that hotel with a relatively higher margin of safety would suffer less as compared to another hotel which has less margin of safety. So both margin of safety as well as the sector are important when we come across such difficult situations. Every good company keeps on creating strategies that improve its margin of safety. So let's explore them. Margin of safety can be improved by improving the contribution margin, which is possible through product differentiation. Stronger the product differentiation, higher the pricing power, and therefore every company has to strive for product differentiation and the pricing power. Controlling and managing fixed costs, because as we have already seen, break-even point depends on the fixed costs. So if we are able to control and manage those fixed costs better, then we can improve our margin of safety. Then whichever are the non-core activities, outsourcing them, taking advantage of labor arbitrage. In case of global companies, even outsourcing them to different geographies, which can considerably save costs. Improving product mix, phasing out low margin products and introducing high margin products. I remember I studied two companies, Colgate and HUL, during 6 years of late 90s and early 2000s. Both these companies had something unique. Of course, HUL that time was about 10 times of Colgate sales. So HUL that time was about 10,000 crores of sales, and Colgate was about 1,000 crores of sales. That was the kind of size difference. But during that 6-year period, both Colgate and HUL hardly had any sales growth. However, if you analyze the statement of P&L and convert it into the contribution income statement, about which I've discussed somewhere else, you can explore that video, then you can calculate the break-even point, the margin of safety, and it was very, very evident that both these companies continuously worked on improving the margin of safety during that 6-year period by creating a number of strategies which overlap with what I have just discussed here. So in spite of the fact that their sales were flat, not growing at all, their profits continued to improve, their profit margin improved, their margin of safety improved. So this is something not theoretical but actually implemented by companies.